So, hello and welcome you to today's Trading Spotlight webinar here on Friday, the 7th of February, 2020. My name is Jens Klatt, and the question here is, can everyone see my screen? So I think you can all hear me well. That's at least something I can see here at my end myself, but can you also see the screen? Perfect. Okay, everything perfect. Yeah, so let's start right away. It's a very interesting topic we want to focus on today. In fact, the question of how to optimize your trading with a trading journal. I mean, I'd like to start before we have a look at the agenda with the following anecdote here. The idea behind this came, in fact, after some time. It took me a while to formulate a topic around this. Because if you listen to traders, professional traders, one second, please. If you listen to professional traders, and if you heard several presentations, seminars, webinars, whatever, you probably have heard several times how important it is to have a trading journal. Now, the funny thing is that it's not just to have a trading journal, but and write down and document your trading well. But I think it's also important to teach people what conclusions get out of what you just written down there, and also what to write down. I mean, it's not only about writing down your entry and the exit point. And in fact, today we want to shine a light on this a little. I give you an idea on not only where and what to document. It's a very detailed data you in fact collect here, but also what conclusions you can drive out of this, even though we only want to shine light on this. And so you will see that the platform we want to use, the external platform FXBlue, is in fact a platform which gives tons of data, which can all be analyzed. And again, we only want to focus here on one idea behind this. I hope that my presentation will result in some kind of fascination, and you will say, hey, you know what? This is not very, very difficult to achieve. I connect my account to FXBlue. I have an external software tracking my trading, collecting data for me, and then I'll take it from there and analyze my data. So that said, today's agenda, let's have a look here. The questions we want to answer is how to synchronize your trading account with FXBlue. In fact, if you also in our Trading Spotlight community, you have the chance to see a step-by-step guide. I posted it already before we started with the webinar today. So that's already one potential point you can go through, or you can go to, and can go through all these steps and connect your account accordingly. Then we also want to have a look here, which data should be reviewed to have an effective starting point to optimize your trading. We want to use data which is then also collected by FXBlue, even though it's also possible, certainly, to get this data yourself by documenting your trading. And then, sure, we want to answer the question, how can we use the data to optimize our trading? Before we get started, a quick introduction, not necessarily to my person. I'm located in Berlin, Germany. That's probably the most important thing here to note. By the way, the reason I am currently dressed like I am, so usually you can see me here sitting casual on a Friday. The reason is that I was invited to the German office from Optimise Markets today to discuss a very, very important and very interesting, in fact, fascinating project. We want to get started here in Germany. I think we agreed on March. This is when we want to start. So to now collect or brainstorm some ideas and everything. And I was there. I'm here in the morning, and I didn't change my clothes. So that's the reason for that. That already gives an introduction to who is Optimise Markets. So Optimise Markets is probably one of the most competitive brokers out there, with a wide range of markets, FX, CFD, offering financial instruments, but not only limited to that. So it's a multi-asset broker, and has offices around the globe, one here in Germany, but also, for example, one in the UK, as an example, or also one in Chile, one in Australia. So around the globe, you can definitely find an office from Admiral. Why is this noteworthy? It's noteworthy because if you're looking for high-quality customer support, not just only high-quality customer support, but also in your native language, Admiral Markets offers a very good chance that you reach out to the Admiral Markets customer support, and there you're connected then to someone speaking your respective language. So definitely worth a look. Here in Germany, in regards to the CFD and the FX offering, I can say that in regards to the DAX, we refer to Admiral among traders, professional traders, as the DAX expert, in fact, with probably the most competitive offering when it comes to cost of trading / the spread, especially. And also in regards to FX, if you watch for a very highly competitive offering in regards to FX trading, I highly recommend having a look at Admiral Prime. That's an offering which is definitely worth a look too, but this is not what we want to look here in more depth today. We want to look here at the topic trading journal, how to optimize your trading with a trading journal. And yeah, unfortunately, this is a little unfortunate because now I have to go here through each point, but I think it's fine with the introduction. So let's come back to what I initially said. In fact, you probably recall some of the webinars we already did in the past. And one of the topics I presented to you was the traits of a successful the traits of a successful trader. And one of these traits I presented here was that I mentioned a successful trader have a trading journal. And based on my personal experience, it's very interesting to note that when I hold presentations, especially in front of people, it doesn't really matter whether they are in English or in Germany. But when let's say I'm holding a presentation here in Germany, one of the biggest trade fairs is the World of Trading. It's usually held at in November in Frankfurt here in Germany. And I hold a presentation there. And then sometimes when referring to trading journals, I ask people, and I do this for several years now, I ask people, hey guys, who of you has a trading journal? And several arms are going up then. And then I ask, okay, and who is documenting his trading well and detailed within this trading journal? And then many hands go down again. And the interesting thing now is, and that's why I refer to having years of experience, it's not very uncommon that holding such a presentation several times and seeing the same faces over and over again, listening to you. And some faces are so, let's say, so characteristic, and you just remember them. And you also remember whether this guy rose his hand when answering the question, do you have a trading journal or not? And even if you say over and over again how important it is to have a trading journal, many people just don't have one. Even though they probably know that's important, but many just fail to document the trading. And then over time, the question arises, okay, why is that? Why is this the case that people know the same thing as follow the trend, for example, follow the trend until it bends, and for example, and why is it so difficult for retail traders to let winning trades run, cut losing trades short? Main reason here, we had this already also in one of the webinars, was loss aversion. That was a psychological reason to that. The same is, in my opinion, true when it comes to having a trading journal. The main reason why many people fail or don't want to document their trading is because they become measurable. That means you can then, if you document your trading, and if your equity goes from the upper left to the lower right, and it's falling and you're losing money, you can obviously see you're losing money. And many people just don't want to be reminded of losing money, in fact. And that's one of the reasons why they don't document their trading, because some people have the tendency to say, I really believe, and I strongly believe that my trading is profitable, and then they still avoid to have a trading journal because they think they are trading a profitable strategy, and they are profitable within their trading, or then they keep on reminding themselves to be profitable, but, and this is the thing, in fact, they are not. And by having a trading journal, if they had one, or if there was such a trading journal, it would be clearly shown to them that they are not profitable, and there's plenty of still work to do. So they are measurable, and they avoid having a trading journal because that measures if they're doing well or if they don't. So, and now the thing is that even if you have a trading journal, let's assume that here, even though it's not the majority of the cases, but even if you have one and you document your trades, then the problem is at the end of the day, many people just do not know what conclusion drive out of this information you've written down there, the data you collected. And this is mainly due to the fact that you just don't know what to look for and what to make out of this information, obviously. So, and this is exactly where we want to shine a light on here today. And in this context, I want to introduce to you FXBlue. It's in fact a website you can join, and it's for free, so you don't even have to pay for that. And some of you probably are already you already know about this, because within the MT4, MT5 Supreme Edition, so the SE product you can download, we also had a webinar on this where I presented some of these add-ons which I use within my trading. And one I used there was the so-called add-on Connect. And let me just show you here on the website. There we go. So this is the Admiral Markets website. You can get to this information. Let me just see here. You can get to this information by going to admiralmarkets.com and then to platforms, and here to MetaTrader Supreme Edition. And then you have to scroll a little, but at the end, you will get to this point here where you have the Stay Connected add-on, in fact. And there you have real-time news directly within your MetaTrader, and not only that, but there's also a chance to analyze your trading activity within the account. So now this is already a great tool, but you can even go a step further here. And this is, and how you do that, that is what I want to introduce to you here. It's FXBlue.com. I just want to share, by the way, the link here, FXBlue.com. And then let me just also offer you here the live right behind, so that you have the, oh, 1 second. Let me just do it here. I'm sorry, I just saw that I had to change. There we go. So fxblue.com live. And you can also go to fxblue.com and then click on the tab right at the top, and then you're forwarded here to the section where you can register. And what you can do is here, you can click on account sync. In this case, you choose which MetaTrader you're currently using, MT4 or MT5. There's also other options, but here MT4, MT5 is the offered solution from Admiral Markets. And then you click on, if you click on register here, you can click on connect. So the thing is, and this is the problem here, I am already registered. So this is one account, one demo account I'm running a basic strategy on. So some of you probably recall that I said I'm nearly fully automated within my trading, and sometimes, or fully automated in regards to how to enter the trade. But then from time to time intervene from a discretionary perspective for whatever reason. We don't want to dig too deep into this, but now the thing is, those discretionary interventions, they have the problem, they are based on my personal opinion, they are based on my emotions. And what I want to achieve here is by having a demo account running beside my live account where I intervene discretionary. And I mean, even this, if I say discretionary intervention, that means in my case, I'm doing this probably less than 10% out of all trades. So that means if you look at 100 trades, over 90 trades are usually fully automated, and I believe, I think that the system will perform better than I do. But from time to time, there's a need to discretionary intervene. For example, if the market is massively extended on the downside, for example, and I know today, based on that, the system will tend to build a short position, for example. Do I really want to be short in an environment where the risk reward on the downside is not very attractive? not most of the time you just don't want to. And that's when I skip the trade, for example, just to give you an idea. At the end of the day, then I look at how I performed compared in my live account, how I performed compared to the basic strategy where I just let the system perform. So just assume that the trade is in fact stopped out then, which the trade I skipped in my live account, but in the basic account, the trade was stopped out. And the stop, let's say, was 100 points or something. What I then do is I document 100 points, but give me a plus connected to that. So it's plus 100. And this is how I calculate and I see whether I perform better than the basic strategy or don't. If I perform better, I review this, let's say, after 50 trades or something, and I see that I continue to perform better than the basic strategy thanks to my experience and my interventions into the trade, then I keep on intervening. If I see that there's a minus, that means that I underperform the basic strategy, I just stop intervening, because based on my experience or emotions especially, obviously I'm most of the time mistaken, and that's why I should just skip these interventions. That's a first step, how to document your trading and how to understand why it's so important to really well document it. And it's in fact very simple. So you just have an Excel sheet and you just write down plus 100, minus 100, whatever, and you sum these numbers up, and at the end of a period, let's say of 50 trades, as I said, you just review it, and if you see that you perform better, keep on intervening. If you see that you underperform the basic strategy, just stop it. That's a very simple way, and it's not connected to your emotions anymore or something. Okay, let's come back to FXBlue and the connection. So that's why we can't really go here into the or through the process, but you have now the website, and I think if that was a German webinar, let's put it that way, if that was a German webinar, probably there is some explanations necessary, but most of you are fluent in English, and so I don't think that it's such a big issue here to go through these steps, because it's self-explaining. In fact, I prepared it here, and again, also here, the Trading Spotlight community. You have it also here. There you can see it if you click on the lower button. So it's Trading Spotlight community. Let me just also add here. I call it TY for Traders Yard, okay? Or TYC, let's go, Traders Yard. And there we have the link. And then here you can see it. I go to the site, I click on the account sync on MT4, MT5, broker server. There we have to look for Admiral Markets, obviously. So we search under A and everything. Account number, read-only password. That's probably something which is a little difficult, because you then have to see that you set yourself, give yourself log in, or not a read-only password, which is not the password you log into your trading account with when entering the trading platform, but one you can send to each investor to see what's going on here within your account without having or giving the investor the chance to do something within your platform. So it's only read-only access, and this is what FXBlue is working with. So you don't need to be afraid that someone has access to your account from an external source, but you work with a so-called investor's password here, or read-only password, which you can then give yourself within the MT4, MT5 environment by going, I think the tab is options, and then you go to via the options tab to the account details here. Okay, so let's go back. Here you have the process, and that's in fact it. So we don't want to look too detailed into these technicals here, but what we want to in fact do is we want to have a look at what you get afterwards. And then we have here the question, the second question we want to answer today. So which data should be reviewed to optimize your trading? So we want to have a look in this case, in this regard, to our already connected account within our Admiral Traders Yard community. So let's go back here to the section. And when scrolling down a little, you can also see that here it's not only me who's active, but there's also Paul, there's also Marcus. And when looking at my posts, you can see every day I am as a Swiss watch. It's like in the morning, I have a DAX setup. There's the details, the key parameters. In the afternoon, it's an S&P 500 setup. There we go. Here are the key parameters. So these are the data, the key parameters for today's trade. It was a short trade. So in fact, I haven't checked it, but I have seen that the NFPs came in better than expected. The market didn't really take off. It was only a short push higher. And so markets are a little under pressure. I haven't really checked what the trade is currently doing, in fact, but I think we are still ahead. If we're not stopped out, then we should definitely be ahead here. And if you scroll lower, then you can also see here the S&P 500 setup. Okay, so you can see I share with you these fully automated strategies, in fact. And this is what we want to use here. I connected both strategies, or the account I'm trading. I'm running a VPS, a virtual private server here, so it's every day, those two setups are traded if the parameters are met, in fact. And if you connect FXBlue, this is what you then usually get. You can see here with those two strategies running on this account, you can see that we now have, let me just see how many trades. Do we have it here? It's 100 trades. There's the trade duration. So by the way, this is the German thing here. So usually this should be in English, in fact, but this is browser based. So I'm using a German browser so that you get the German data here. But in fact, what we want to focus on, in fact, is the stats tab. Let me just see how many trades we're looking at here. So this is not on the first page. You can also look here at the symbols, in fact, and there you have 77 trades in the DAX, and you have 73 in the S&P, in fact. So we're looking at 150 trades in this case, which is, by the way, not that much. Let's be honest here, because if you have 2 trades a day and you have 250 trading days a year, that means you should have 500 trades for having 1 year. No, you should have 500 trades, around 450 to 500 trades to look at 1 year of data, in fact. So what we do here is looking at data which is, from a statistical standpoint, not really relevant. But this is not what the reason for that webinar is, in fact. So you can easily extend this data then over time, and the process to go through the numbers you want to review here is the same. So just to give you an idea, what happens is that if you're connected to FXBlue, all these data is here then collected. So you have the gross profit, you have the net profit, the profit factor, winners, winner percentage, losers, loser percentage. You can also go here and look, for example, at the average length of each trade. Why is this important? Why should you have this data? So there are certain techniques you can use. For example, you can say if the market is not doing what I wanted to do. So I have a strategy, I have a clear plan, the market breaks out, but then we don't see the market strongly moving in the direction which I hoped the market to go, or to move into this direction. And you say the average length of a trade is, let's say, 4 hours, but if my data shows, and you can play with the data delivered here, we will use a filter, in fact. You can then have a look what happens, for example, for all trades which have a duration of 1 hour. So and you look at this and you see that most of these trades, if they haven't hit your take profit level, for example, within 1 hour, but were stopped out after 1 hour, you should probably think about reducing at least the position size. That was something we call scaling out, and this is how you could use this collected data here to improve your trading, because if the overall performance can be the performance, the equity curve can be smoothened by intervening here and reducing the position size, then because the chances are higher that you're getting stopped out and you face a losing trade instead of having a winning trade, that means you improve your trading already. And this is the next step to become profitable with this certain strategy, respectively, on your path to become a profitable trader. So this is very, very important information, average length of the trade duration. And in fact, no big coincidence that at the first page already, where you only have a short wrap-up of all the infos being collected, that you have here all trades, and then you can look at the profitability of each trade depending on the length. What you can also see here is very quickly that I have a clear stop loss set for each trade. So it's obvious that I'm not losing more in this case than, in fact, what's the biggest loser? So that's probably because of slippage or something. But all in all, you can see that the average loss of each trade was 80 to 90 euros, something like that. If you start with a 10,000 euro account, that means the initial risk was given at 0.8 to 0.9%. And obviously, I'm very, very, very strict here with keeping losses small, cutting losses short. It's also something which you can see here. For example, at first glance, in fact. So let's come back here. So we already had a look here. As you can see, we have nearly endless information. Okay, our main focus here, and now we want to focus on certain parameters. So first of all, we want to have a look certainly on the hit and loss ratio, or hit and loss rate. Then we want to look at the average gain, respectively the average loss. So there's a slash missing. We want to look at the trade duration. In fact, we already did this, and we want to look at the profitability of each strategy. So therefore, I will guide you here through how to get there at FXBlue. I just want to dig a little deeper into the first two aspects here. Unfortunately, now I have to admit. 1 second, please. I have to open a document for this. I hope to be prepared, well prepared here for the webinar, and now I'm missing one of the most important aspects. So I have a document I can use to write something to. So there we go. Let's have a look here. So why is, let me put it probably on this side. Why is the hit loss ratio and the average gain, respectively the average loss, why is this important? It's important to get a number which is here printed as expectancy. So there you can see it. Where do we have it? Expectancy. Let me just see. There we go. There it is. So it's the average expectancy, in fact. So in Germany, we call it durchschnittliches Ergebnis. In English, it's average expectancy of a trade. So what you can see here currently, this is no big surprise. It's minus 3.83. Why isn't that such a big surprise? Well, we're below water, so you can already see it here. So this is the line. This is where we started. That was the initial deposit of 10,000, and now we are below water, which means we must have a negative expectancy per trade. But this is not what we want to focus on here. But what this number, or where you get this number from, it means nothing more. What can you expect per trade to make? Okay, so that means nothing more. You multiply this number here with the number of trades, in fact. And from here, then you get your overall result. And that's why here, even though it's only a number which is of theoretical use, but still it also emphasizes probably once again why it's so important to let winning trades run, cut losing trades short. So the expectancy, we call this expected value, it's EV, is given by the average gain multiplied with the hit rate, and then you subtract, oh, there we have it. You subtract the result of the average loss multiplied with the loss rate. So let me just see that I get this in one line. Oh, okay. Okay, that doesn't work. So let me just do it that way then. So we have the expected value given then by multiplying the average gain. Here's the average gain. You multiply it with the hit rate, and then you subtract the average loss with the loss rate. So why is that of importance? Because it emphasizes, for example, from a pure theoretical standpoint, you probably have heard about this. You can read about it in books, and everyone is talking about, professional traders are talking about that. Let winning trades run, cut losing trades short. The only question is, why do they say that? I mean, at the end of the day, when looking at the chart and you see a chart going from the lower left to the upper right and a strong trend, let's say in the Apple share or something like that, well, yeah, you obviously understand why if you bought low, it makes sense to sell high, okay? But this is not getting the job done to fully understand why letting winning trades run and cut losing trades short. It has it finds itself the reason as it can be found within the expectancy or the expected value, in fact, because here you can see that every number which is going up here in the first term, in this case, the average gain, then, if you let the winning trade run and the gain grows larger, and the average gain grows larger, that every number or every result which is pushing this number higher while cutting losing trade short and thus limiting the loss, the average loss that way here, will follow this let winning trades run, cut losing trade short. That means it increases the overall expectancy of your trading. The expected value grows larger, and thus is nothing more than it means you become more profitable with your trading. So that's the explanation behind this, and that's why we should carefully watch those numbers. At first glance, certainly, you will say, okay, but this is just a theoretical approach. And if we go back above the back above water, then we have a positive expectancy. But what can I draw out of this? Well, you can at least get an idea on whether the average loss you're currently facing, especially here when looking at the average loss, whether it's probably too large. Probably you have to find ways to reduce it. Probably, and it means nothing more than not just the position size is too big, but probably also it's too big when you look, for example, at your overall trading capital you're trading with. So if the loss here is too large, then you probably have to find ways to reduce the position size in cases of losing. That might sound ridiculously easy, but or that it sounds ridiculous at first glance, but you will find out it's not very easy to do so. But this is something, or the information you can get out of this, and that's why it's so important here, especially when looking at the fact that it mainly affects your expectancy on your trading. Why it's so important to look at these numbers, in fact, and have a clear overview and quick overview of this. And that's no coincidence that in case of FXBlue here, this is something you can find right at the first site here below risk. So this is the risk top in this case, and there you have the average expectancy, and there you have the average gain, and there you have the average loss, while the hit rate, in fact, can be found. Let me just see, where do you have it? Here. There we have the hit rate, so it's winning trades. So losing trades is something you can't see here, but it's not really necessary because winning and losing trades up to 100%. So if we have a hit rate here of 39%, which is, by the way, something we will see a little later, not very good, in fact, and points already to a market environment which is not very favorable for trading strategies right now. But when looking here at this number, it means that 61% or more than 60% of the trades must be losing trades. So, okay. Let's move on. Let's go to the next tab. So now the question is, how can we use these numbers to optimize our trading? So again, currently this is difficult because both strategies are in the red, but we also, this is a number I should have updated this to. So we have below 200 trades in this case now. But let's try to pigeonhole the current results here. So now, something very interesting becomes obvious because I told you we are looking at two strategies. So we are trading the DAX and we're trading the S&P. So what we have here is a mixed result of both strategies being traded. This is not really valuable. Okay, so because mixing up strategies is very, very difficult, because it could be that market environment is currently favorable for one strategy while it's not very favorable for another strategy. And this is especially true if you're trading more than one market and more than one strategy within an account. So now there becomes aspect becomes visible, which is so important. And when especially looking at the MetaTrader 4, MetaTrader 5, you have, when you trade, the possibility, let's assume you're also an algorithmic trader, in fact, you have a chance to give yourself a so-called magic number when trading. A magic number is a number you where you can then afterwards say, okay, that was the trade I did here based on this strategy, and that was another trade I did here. So in case of our two strategies I'm trading here, I gave the DAX the magic number 100 or 1001, while I have the S&P with the magic number 1002. So that makes it possible for me to look at each strategy different or independently from each other. So now, how can we see this information? We go to stats in this case here, and then we go to strategy. So there's a strategy tab. You can see plenty of information here. We were there already several minutes ago with symbols. So you can easily say, okay, I have a DAX, S&P. If you're trading gold, if you're trading Euro USD, dollar JPY, whatever, you will also see every trade and the result connected to this. You have the direction here, buy, sell. You can look at the symbol and the direction. Then you have already 4 tabs here. You can, for example, see the net profit for the DAX in this case, if we traded the long side, was positive, while the negative result we're currently seeing, which is only 20 euros minus, in fact. So the main loss, you can already see it, comes from the S&P 500, for example. So the DAX, all in all, is trading okay. It's not bad. It's still okay. It's break even, but at the end of the day, market conditions are obviously more favorable when it comes to DAX trading than when it comes to S&P 500 trading, for example. So, and now you can see here, if we only focused on the long side and skipped all losing trades, the result would be already significantly positive, for example. In case of the S&P, well, the long side is catastrophic, with the biggest loss here, the so-called net profit. While if you focused only on the short side, well, the profit was okay. It's not outstanding, but still, this is already something which is of high value for us, because one strategy is probably currently finding itself in a favorable environment when it comes to long positions, while the other is favorable, or should be favored under short market conditions or bearish market conditions, whatever. Similar direction. So then you can also look at the monthly, weekly, daily, hourly performance. Day of week, also something really interesting. Which are the days I can or I should focus on when trading? Well, obviously, Fridays today is a beautiful day. Let's see if this continues to work out pretty well. You can see here we had a profit of nearly 10%, while all losses were nearly or resulted out of Thursdays and of Mondays in this case. So these were horrible days for our strategies. Again, we are only looking here at 30 trades, so this is of not high, statistically, that is irrelevant. It doesn't really matter. But it's just to give you an idea of how to get useful information out of FXBlue and your connection of your trading account here. And then we have the strategy tab. So we have 101, 101, this is all DAX trades, and 102, this is all S&P trades. And what you can see here is then that you have, for example, a net profit of minus 22 euros, which is nothing, which is nearly break even, let's say, while the S&P is obviously finding itself in a very, very difficult spot right now. There's also other chances you can, or information you can draw out of this. You can, for example, see the hit rate. It's only 39% in case of the DAX, while it's 40% in case of the S&P, which is very interesting when looking at the net profit. So obviously, it must be that if the DAX moves in our direction, it really moves strongly in our direction and is highly likely to reach our take profit. While in case of the S&P, this is not necessarily the case. We have a higher hit rate, but the result is obviously not very favorable, which means in case of a breakout strategy, obviously, or most likely, the market presents itself very choppy after being triggered in one or the other direction, for example. It's one conclusion you could derive from this. You have also the chance to look at the average gain, the average loss here. Why is that of interest? Let's go back to the slide here now. And then there you can already see why it's so important to have a solid backtest, because you have something to compare your stats to. We want to do this with the S&P because the result is so bad, and also because we have a very, very solid backtest. Some of you probably recall within this Trading Spotlight series, we had a webinar which was dedicated to the S&P 500 open range breakout strategy, where I presented also a very solid backtest result over a time span of over 7 years, in fact. So let's here look at the hit loss rate for both strategies. So it's only 39% for the DAX. It's only 40% for the S&P. Historically, so I did 47 to 49%. Because it's two strategies I'm looking here. That's why I use a range. But when looking here at historic numbers, it's between 47 to 49%. You will see this for the S&P lying around 46, 47% over its time span of 7 years for the backtest result. Then let's look at the payoff ratio. Another very important number I presented to you here several minutes ago with the average gain, average loss. For the DAX, it was 1.65 to 1, respectively. This is the current result, okay? Respectively, 1.15 to 1 versus 1.3, 1.4 to 1 historically. That's also an average number I'm working with here. So where do I get the average gain, average loss from? Let's go back to FXBlue. You can see it here. You just divide 115.16 in case of the DAX here through 73. Yeah, let's say 74. Probably it's even a little bit better. I haven't adopted this. Let's say it's 115 through 74. No, it dropped. We are at 1.55 in fact. So we came down from our favorable result. Let's say it was something like 3 weeks ago. So when I prepared the presentation here. So now the thing is, I've already given us an explanation. So market conditions, especially for the S&P, are not very favorable. But we want to have a look at why it's so important to have a solid backtest here, because now you can compare these numbers you have under real market conditions and compare them to our backtest result, which I already presented to you. Compare the numbers, very simple. So you look at what we currently have. Hit rate is 40%. If you look at the hit rate here for this time span from November 2010 to July 2017, you have a hit rate here in this screenshot of 47%. While if you compare the average or divide the average profit by the average loss, you get out at 1.31 to 1, so 1.3 around. So currently, it's not only that the hit rate is below the historic result we've seen for our backtest here, 47% historically, while we currently only see 40%, but in addition to that, the payoff ratio is also below what we've seen historically. So market conditions are, in fact, based on only these two information. That's why it's so important. Historically, when looking at historic results, we can say market conditions are not very favorable for the S&P 500. Even though you can also see, if you continue to trade the simple approach, then the equity curve goes from the lower left to the upper right. So it rises. Only what you can see here is probably an environment here, or also an environment here, where market conditions are obviously not favorable for the strategy. But this is something you can, or based on this knowledge, you can easily work with now from an emotional perspective. So it's not that you say, oh my gosh, the strategy is not working anymore. It's, if you compare it to historic results, you can say, okay, currently it's not working, but that doesn't necessarily mean it's not working anymore in the future. But currently, market conditions are not very favorable, very choppy market conditions. Markets are not strongly trending in our direction. If we hit, the market is just bouncing back and working like, yeah, it's like yeah, choppy. I think that's the way I put it. So now, oh, I'm sorry, that's a little unfortunate. So now I will show you something which is really cool, and something from which you can start to massively extract valuable data or valuable information based on the data being collected. So what I have here is also a screenshot from FXBlue in this case, and we can filter data. We can filter data and then have a look at, for example, the performance of a strategy, and then on each trading day, for example. So I just want to show you how this is done. It's very easy to achieve. So you click here on filter, and then you say, let's have a starting date. So let's go back to something like, I don't know. I think this is probably, I want to have all data. This is a little unfortunate here because there's no such tab as all data, but now we can be sure that all data is looked at here. And then what we do is we here give just a 1002 to the magic number, and we click on filter. And then you only have all trades on the S&P. And not only that, but now what you can do is we can switch the tab, and you see all trades here each day of the week. And let's use the screenshot here within the presentation, in fact. So there you can see Monday, 12 trades, nothing. Again, statistically completely irrelevant, but this is not what we are after at here. What we can, for example, say is Thursdays, horrible. Wednesdays, horrible. Remember what happened, just what I did, in fact. given the information we had several minutes ago in regards to both strategies, where the result for Monday was, I think, minus 700 or something, that means that here Monday is not the worst day. It's, in fact, the worst day for the DAX strategy, obviously. We could easily look this up, but we won't dig too deep into these details. But this is something you can then say. Based on such data, in fact, you could optimize your trading in a way that you say, easily. It's very easy to set, but skip Wednesdays and Thursdays. If you skip those 2 days, the strategy becomes obviously profitable. Again, this is not how it's done, and it's too easy because you can't just skip Wednesdays and Thursdays here, and because it's probably just massively under expected value, and over time that will outperform other days then, and you will see a sharper bounce back here. And especially, this is especially true since we are only looking at here less than 20 trades, so it's not really valuable. But something you can already see is that there's plenty of chances for you to analyze the data being collected based on your trading, and then draw conclusions out of this and try to improve your trading. How you do this depends on your trading style, depends on your personality, depends on your probably also life situation, for example. So some of you probably might say, okay, that's probably very bad because I'm a student, and once I run the back test, I run it only on Wednesdays and Thursdays. Just give a rough example on that. And so now I find out that Wednesdays and Thursdays are currently massively under the expected value, and the strategy is not performing really well, which means that by skipping Fridays, for example, it's horrible. It's just a horrible result. Let's nevertheless draw other conclusions out of this. Let's say now you're not only looking at less than 20 trades, but we are now looking at 100 trades, which is already massive data, because it means 100 trades on Friday, and here on Monday, Tuesday, Wednesday, Thursday too, which means 500 trades. And since we're doing 1 trade per day, and a trading year is 250 trading days, that means you're looking at 2 years of data, and each day there was a trade. But this could draw, or you could draw the conclusion out of this, that you say, well, you know what, I only trade the strategies on Fridays. But if you don't have a trading journal, and that's what it all comes down to, if you don't have a trading journal and you do not have all this data collected, and you have not a real solid fundament based on which you say, I only trade on Fridays, this is, yeah, I think we all agree this is really bad, because it's based on an emotion, it's based on a gut feeling, which is certainly fine. But when it comes to trading, I am more the guy tending to look at clear data and on a proof, and have a proof that my intention or my gut feeling is correct, than just rely on my gut and say, well, it will work out. It's better to have clear, clean data showing that your intention is correct or it's not. Okay, so since we are running out of time a little, I have to hurry up here. So let's sum all these informations up then. And for further information, feel free to come to the Traders Yard community, ask your questions there, your how to connect your account, how to work out this data. Probably you say the question like, hey, I have this and that data. What conclusion can I draw out of this based on this strategy I'm trading, for example? So the community we have there is, the idea behind this is that we share ideas, that we share experiences, and that we all profit from each other. So feel free to reach out to our Traders Yard Spotlight community, ask your questions there, for example, especially connected to your then hopefully FXBlue connected MT4, MT5 Admiral Markets account. So one key of successful traders, one key trait of successful traders is that they have a trading journal. So I think based on what I've just presented to you, based on the information which is collected, or the data which is collected from FXBlue, you can see why this is of such high value for traders, and why most profitable, successful traders rely on trading journals and say it's so important to have one, because else they wouldn't be capable of analyzing this data accurately and work with it and improve their trading based on this data. And then, in this regard, I highly recommend you to synchronize your FXBlue account or your trading account, your MT4, MT5 account to FXBlue to collect data and not only in regards to your hit-loss ratio or also the payoff ratio, but also in regards to your day-of-week performance, the trade duration, for example, and all this to draw conclusions out of it. And this will certainly help you to analyze your trading in depth and objective stats, not feelings, which are emotion-based and thus underlie so-called cognitive biases. We had plenty of webinars and ideas around this over the last months. A webinar, I think it's 2 weeks ago, we had the bandwagon effect, for example, in this regard. When it comes to cognitive biases, loss aversion is another one. And yeah, such a quantitative step requires having a clear and clean trading strategy you follow. That's the first step, which it starts all with that. If you don't have a strategy, if you don't know what's your historic hit rate with the approach over a very over time span, which is also statistically relevant, all this doesn't make sense, because you don't need to analyze your trading, because you don't know if the numbers you have collected then to what to compare them. And if you don't really know the historic hit rate of your trading, this is where it all should start. This is also where mental stability and trading comes from, because you know what you're doing, in fact. And don't forget to join us next time. So again, I have to wrap. I'm sorry. I'm so sorry, but you can hopefully feel that it's a very, very fascinating topic for me, and we could easily talk hours about this and draw conclusions out of the collected data. On Monday, I'm sorry, not on Wednesday, on Monday here, Paul will here be for you and drive or guide you through psychological stop loss. And psychological stop losses is like, you don't set one within your trading strategy, but you have one in your mind. The different types of psychological stop losses in this regard, how to use them as an early warning system, in fact, and also how to return to trading once they have played out. And which time? 2 p.m. London, Monday. It's the 10th of February then. It's the same time as today, 2 p.m. Check your inbox for the webinar link. If you're watching this on YouTube, then don't forget to please, if you enjoyed what you just saw, don't forget to give probably a thumb up. That would be highly appreciated. For registering for the live event, this webinar, go to optimise.com and there to the Educations tab and on Webinars Trading Spotlight. And for more analysis in general, all informations around Optimal Markets, feel free to join the website, optimalmarkets.com. These are the contact details, and this is the risk disclaimer. That's it from my end. I hope you enjoyed the webinar. All the best. Happy weekend. Happy trading. Enjoy yourself. Talk to you again next week on Valentine's Day. Yes, on the 14th of February. I look forward to it. Have a nice weekend. See you, and bye-bye.